and welcome to Everything About Wealth, the podcast. This podcast is focused on wealth building, and I am your co-host, Desi Troncoso. This is episode number 5. If you were with us on our last podcast, episode 4, Denny and Paul Winterroad reviewed Fannie, Freddie, and HUD loan programs. We continue this conversation on this episode with portfolio loans and bridge capital options to acquire multifamily properties. By understanding the financing, you have a better idea of understanding the deal and your return on investment. If you don't already follow us, make sure to follow us on Instagram and Facebook at Everything About Wealth. To reintroduce Paul Winterroad, he is a commercial mortgage broker with Bonneville Multifamily Capital. He focuses on providing financing to multifamily properties. He specializes in 3 areas: HUD FHA, Fannie Mae, and Freddie Mac. He also has some bridge capital and portfolio loan options. Paul has helped us in the past to obtain financing, and it has always been a pleasant experience working with him and his team. So let's get started with episode number 5.
Hello, everyone, and this is Denny Troncoso here again, and I'm here with Paul Winterroad to do our part 2. Paul, last call was talking about Fannie Mae, Freddie Mac, and HUD loan programs, which is something that he specializes in. He's an expert in the field, been doing this a long time, and he's also an investor that owns over 120 doors of multifamily. So without further ado, Paul, are you there?
I am. Thanks, Denny. Good to be back.
Hey, glad to have you back, Paul. I'm going to get right into it. I know you had talked a little bit about your background and what you do with loan programs. We hit on Fannie, Freddie, and HUD, but we definitely wanted to talk about some of the other loan opportunities that you have for investors that are buying multifamily properties. And a couple of them were bridge capital and even portfolio loans when you're buying basically a portfolio of single-family homes or small multifamily. Can you touch on those?
Sure, happy to. Let's talk about the bridge first. So it's very common. Almost everyone we talk to is looking for some sort of value add opportunity. When they're getting into multifamily, syndicators love a value add play because that's how they're ultimately making the bulk of their money on the back end, and opportunity is really the name of the game. And so when there is that opportunity or that value add, a lot of times the existing income doesn't support the sort of leverage that we'd like going into an acquisition, with cap rates across the board having compressed over the last few years. That's driven pricing up. And so what we find very frequently, working on a deal right now in my market for some investors and syndicators, that the in-place, it's completely occupied. It's a 58 unit complex, but it's been self-managed by the current owner, and rents are very low. And so when we've looked at Freddie Mac small balance, for example, which is really the best perm program for them, our loan amount is coming in at about 60% loan to purchase price. And so, of course, the more leverage you can have or create in a deal, that can increase your returns, both to you as an individual investor and as a syndicator. So most people we're talking to, especially on the acquisition, want to get as big of loan as possible. And so when the conventional or bank loans will only provide a 55, 60, 65% leverage, not including any rehab costs, then it makes a lot of sense to look at a bridge or even a construction loan from a local bank or credit union. I'd put it in that same bucket, but a lot of banking institutions will call it a construction loan. So that's a rather lengthy intro as to why, but in the bridge space, there's a wide array of options. And the best way to wrap your head around it is if you want low rates and still a higher leverage, but if you're looking for closer to that typical conventional bank Fannie Freddie rates, there's going to be a lot more underwriting in the process. If you're willing to accept a higher rate, there's less underwriting. So there's a whole spectrum. And I just want to clarify with you, Denny, does that make sense before we move on? That I've got a database of 100 different bridge lenders, and they're going to have different appetites for different markets. But generally speaking, if you want a lower rate, it means more underwriting closer to what you need to provide a bank or Fannie Freddie, and then the less underwriting is going to have a higher rate and a higher cost to it. Does that make sense?
Of course, that makes a lot of sense. And something that you mentioned, so people can wrap their heads around bridge capital, since a lot of the listeners are people that are just coming into the space of multifamily. Maybe you've owned another business. Maybe you've worked with single family properties. Bridge capital, I want you to look at it more of like hard money lending for single family homes. And that's with larger properties and commercial, they call it bridge lending. And the reason Paul is saying that a construction loan is a good option is because sometimes you can get better interest rates, maybe from a community bank than from a bridge lender, because the interest rates on bridge, what are they ranging, Paul?
Yeah, I would say on the very low end, but these are good properties, great locations, starting in the 6.5 range. That's probably going to max out at about 75% loan to cost at that sort of rate. But when we say cost, that can be both your purchase price and rehab budget. And it's going to range all the way up to hard money, just like you said, the 12%, 4 points in that range. But again, if you need to close in a week or 2 weeks, or have really rough credit, but there's a great opportunity, that's where you are. So there is a broad range, but when you get to that higher end of the spectrum, as far as rate and points, that's where you can increase your leverage to, let's say, 80% of your purchase price and 100% of your rehab budget. So you may be all in on 85, 90% of your cost. Now, most lenders will want to see that after repair value showing 75% loan to value or 70% loan to value, so they know that there's some cushion in there, but they will push those limits going in if you're willing to pay for it. And I've seen it pencil and I've seen it work. The big caveat and caution is you've got to be very, very crisp and very efficient. There's not a lot of room for error in those higher cost end of the spectrum if you're going to make money in the end. So you got to be sharp when you're doing that, but it is doable.
Of course, because you're paying higher interest rates, and you're paying a lot of fees up front. So you have to make sure that the deal is going to work, that you're going to be able to complete the renovations within a certain amount of time, so the deal can cash flow, and then you can probably get out of the loan within. Typically, the loans run about 12 to 18 months, is what I see on Bridge Capital.
Correct. Yeah, and then some of the lower cost ones may even be 2 or 3 years. So there's a lot of different flavors. That's where someone like me, and I'm not saying I'm the answer, but a mortgage broker that has really that network to go to and tap into is really going to be valuable to you, especially on a bridge, because a lot of these sources of capital are not mainstream. They don't market to the end user. It's through the broker channels that they come about. Just a quick story to show you what can be entailed in this and what we do. There was a deal came across our desk last fall, and it was a very unique conversion from a assisted and independent living facility to a multifamily facility. Typically, your cap rates are higher and your income's higher on a senior facility, so it's quite rare that you see them transition into multifamily, but it does happen. The sponsor on this deal was an expert in that senior living space, and they came across this deal, but they just couldn't make it work. And given the location, it just penciled better to become multifamily. So they put together this plan to convert it to a multifamily project. Well, they had worked with actually a different broker before coming to me, and they had some success, but they weren't really happy with the option that had been provided. And so we agreed to, with them disclosing which capital sources they'd been talking to, jump in and see if we could improve upon that. And actually reached out to over 40, I think the final count was around 45 different lenders.
Wow.
And only a handful, I'd say 3 or 4 had real interest, but we were able to find a lender, a group that ironically had experience in this space converting a senior facility to a multifamily, and they'd had success with it before, and they were able to wrap their head around it. We were able to get better terms than the other broker had provided, and we ended up doing the deal. The moral of that story is it's not easy or simple to first have that database and then have the determination to reach out to that many sources of capital. And I would say that's an extreme scenario, but sometimes that's what it takes to get the deal done. But they got great terms, and they're off to the races. And so the project's going well, but they were able to get rehab money included in the deal. I think we got it to 80% of total cost, maybe even 85. I'm sorry that some of those details are a little foggy, but they were only needed to bring 15 to 20% cash down, and they were putting about $1.5 million into the property and purchased it for right around 6. I don't have the exact details in front of me, but that's close to where it was.
But that shows the value of working with a mortgage broker, because if not, a borrower is either, at the beginning when I started, I had to go through about 30 lenders to find one community bank that would work with me. And like you said, there's some bridge capital lenders that they're not out there marketing themselves. They go through the broker channels. So yeah. I think that you're willing to go that far and to get the deal done, it means a lot. And I think that's a very positive thing of hopefully the person working with you or finding a mortgage broker that's willing to do that.
Certainly.
One thing I just wanted to touch base on the bridge capital that you mentioned that you can roll in the renovation dollars and the purchase price into the deal. And that's big, because a lot of the lenders, the community banks, very few will allow you to do that.
Yeah, and that's why I mentioned a construction loan. So we have used this strategy with some of our clients instead of just doing a permanent acquisition loan, even on an existing property that's built, usually run down and needs some repairs, but we'll go in and we'll do a construction loan. And it really is a bridge loan but there's rehab dollars, and they'll look at loan to cost, and they'll look at including those funds. So rather than take a $2 million property that is depressed, only has cash flow to support maybe $1 million loan, but with $500,000 worth of improvements, it may be worth, this is an extreme scenario, but it may be worth $4 million, but your purchase price is $2 million. Well, rather than getting a loan for $1 million and then coming up with the rehab budget with a construction loan, and community local banks and larger banks will get this and understand that your purchase price is $2 million, you have $500,000 of rehab, so your loan to or your cost is 2.5, and then they'll do a 75% loan to cost, and so dramatically reducing the amount of money you'd have to bring to the table to get that done. So that's a great way to do it, and just a couple general rules of thumb. A lot of the bridge lenders really don't like to deploy their capital until they're getting to that $4 or $5 million loan amount. Yes, there are bridge lenders out there that will do smaller deals, but they're less common. It's more common for bridge lenders to want the $5+ million type deals. And so the community or local bank for a construction loan that acts just like a bridge, and you're candidly going to get better rates than most of the bridge programs anyway, is a great strategy that I've personally used in my own investing and have helped clients do, and it works really well.
Awesome. Thanks for that information, Paul. Can we move on to the portfolio loans? Can you talk a little bit about that? I know this is a little bit of a more complex and specialized area, but I know that you know it probably better than anyone. So if you can give us...
Well, I don't know about that. I'll give you a couple pointers and ideas on this. So it's a tricky space because we get this request a lot. Hey, I've got a bunch of single family properties. I want to roll it all into one loan. Freddie Mac had experimented with this program, and it seemed to go away just as quickly as it appeared. It may have only really been on the shelf for less than a year, probably 6, 7, 8 months. And I'm not exactly sure why it went away, but they just couldn't make it work the way they wanted to. And so they rolled it out, and then it went away fairly quickly. So for portfolio loans, it's really private lenders. And again, I would go back to probably a regional bank is the next best place, a portfolio type bank. And when I say that, there are lots of banks and mortgage brokers in the residential space that are originating loans and securitizing them. They're selling them into the Fannie and Freddie pools. But there's a lot of banks and credit unions that don't do that. They keep those assets on their own books. And so they would be considered a portfolio lender or a balance sheet lender, where they're keeping all those loans internally and servicing them and providing their capital for those. So when you work with that sort of lender, or call it a regional bank, they're gonna be able to wrap their head around that and do that. We have some of our larger Fannie Freddie resources that they aren't Fannie and Freddie loans, but we can pool the assets into one loan. A couple things to keep in mind, whether it's a private lender or a bank on a portfolio, is you're going to be paying a higher rate than you would if you were doing a Fannie Freddie loan that's ultimately securitized. So what happens is they're really treated like a commercial loan. So you get into that space of 25% equity or down payment. They could require more, but that would be the max leverage, like a 75% loan to value would be the max I would expect. And if your Fannie Freddie rates are at 4.5, I'd expect your portfolio rate to be about 1% higher, maybe a little better, but just on average, probably a point or 1.5 higher. So you'd be in the 5.5 to 6 range on a portfolio. So the advantages of it makes your life a lot simpler and frees up some of those Fannie Freddie loans that you could, the 10 or whatever is allowed for you to get. You could portfolio a bunch of those deals and then sort of recycle those 10 that you could use. So we get those requests, and I would say most people like their lower rates, and so although they have an interest in the portfolio loans, we haven't seen a lot of investors doing those. But I'm not saying that there's not a market for it and there aren't banks, but just my own experience is that most people that I've worked with have shied away from going that route, or they've worked with an existing banking relationship.
Got it. It sounds like you mentioned the interest rates are slightly higher, but what about the amortization schedule? Is it 25 years or 20? Because I know with commercial loans, some lenders, they just do 20 years with that.
Yeah, I would say 25 is probably the heart of that market. There's undoubtedly lenders out there that would go to 30 on that. It's probably more like your story where you'd have to knock on a lot of doors to get there. So I would plan on that. And then again, a common commercial term is that the rate would be fixed for 5 to 10 years. And so there may be a balloon payment or a reset at that point. It's really going to be lender specific on what they offer, but the basic premise is that you're playing in more of a commercial loan space than a residential loan. You lose some of the characteristics of the residential loan.
Cool. All right. Well, good information on the portfolio loans and the bridge capital. For new investors, and you've already mentioned one of the biggest benefits that you bring to the table, which is having that access to the different types of lenders and the relationships that you've already built with those lenders. But any other things that you would like to share where new investors, that you can help them put their first loan together, such as maybe the positioning of the loan package? I know you helped us in our business when we were shooting to get the first HUD loan. And you mentioned, well, we need to, build your resume a little bit and recommended some different strategies how to do that. Can you share some examples?
Here's one thing that's been on my mind, and you learn. I try to learn and get better every day. I'm just plugging along. I don't have all the answers, but one thing I've been thinking about that I'm going to help my clients do more and encourage them to do more is really take control of the investment and where you need to be. And let me dissect that for you a little bit. Here's the typical scenario. And there's nothing wrong with this, but this is typically the phone call we get. Hey, Paul, I got this property I'm looking at. I'm really interested into it. What can you do for me? What's my rate going to be? What are the terms? And there's a number of different variables that go into that. And I can give a ballpark and say, hey, here's where we'll be, but we really need to dig in, underwrite, and understand what it is and shop it out and get those best rate and terms. And I'm always going to work really hard to get the best rate and terms. But when I say flip the kind of turn the tables, if you will, I think it's incredibly powerful if an investor, whether new or experienced, has a pro forma, has taken the time to underwrite the property and say, hey, this is how I'm going to operate this, and these are my assumptions, and this is what it's going to be, and I'm going to hold it for 5 years, and this is my internal rate of return, and this and that. Well, there's lots of variables in that spreadsheet, and one of which is your loan. How much leverage? What rate? How is that going to work? And so the whole key to this is deciding, hey, what is my personal discount rate, or what is the threshold as far as a return that I need to achieve? Well, let's say it's 12% on a deal. Well, you underwrite it, you put in all your assumptions, and you say, great, this is going to yield me 18% IRR. Perfect. Well, you don't know if you're going to be able to get all those terms. And so you can start playing with it and backing it out. And this is where you need some Excel ability. But there's a tool called GoalSeek that I'm getting out into the weeds here, but you can start playing with, hey, if I change this number, what will yield me a 12% return? And so the whole premise of this is saying, okay, I need to get a 75% loan to value loan at 6% to achieve my 12% return. And then you know, hey, these are the terms that work for the deal. And then you can start backing into it. And so if someone came to me and said, hey, this deal doesn't work for me unless I hit these terms, I'm going to say, great. I think we can do much better than that. Let's go to work. And every time we do improve that, that's going to improve those returns. But if I say, hey, if you need a 4% loan on a 50-year AM to hit your 12% return, you should look for the next deal. And I'm not going to invest a lot of time in that. But hopefully that makes sense, where you're coming to the table, you've done your diligence and said, okay, here's what I need to make this work. This is my threshold. And if I don't hit this, then I'm going to go the other way. I just think that's a more sophisticated and intelligent approach, rather than, hey, I like this deal, I'm going to, see if I can make these terms work in order to do the deal. Tell me if that makes sense, or if there's any gaps in what I've explained there.
No, I think it makes sense. And I think what it basically does that I could see, it's a bit of I call it a gatekeeper is a word that comes in, but basically saves a little bit of time where you're doing some work up front and you see, hey, at 6%, it doesn't even work. Would it work at 5? With 30 years. And then if that doesn't work, you can say, well, look, I've already underwritten it at 5. Paul, can you do any better than 5? He's like, no, frankly, the rates are in the 5.5s for that type of loan. So don't spend any more time with it. So I think that,
yeah,
I think that's a good thing.
You can get a ballpark of where things will be, but knowing that will be really helpful. And then if it exceeds those thresholds, it's just more money to you or your investors. I mean, how good of a call would that be to your investors to say, hey, we knew it would work at this level, and these were the returns. We were projecting 16% returns, and I did a great job working with our mortgage broker, and we got better terms, and now it's going to be 20% IRR. I mean, after people have already committed, that's a great thing to be able to do.
I think that's, you look like a hero if you do that. On the side of people being aware and penciling, I think you shouldn't call your mortgage broker and trying to ask them about rates. I agree with you, unless you've run a pro forma. And if you've put a spreadsheet together, there's some simple spreadsheets you can use where you don't have to create this big elaborate thing and it takes you 3 hours. You can just plug in some numbers and it'll give you an idea of where you're at in 10 years. You just takes you maybe less than 30 minutes, 20 minutes to do it.
Sure.
And on the other side of that too, something that I try to do personally is stay informed with the market and what market rates are doing. So even if I don't know exactly what the rate is right now, if it's 5.25, at least I know it's ranging somewhere between 5 and 5.5, because it's not fair at the same time to call your mortgage broker, whether it's Paul or anyone else, on a daily, weekly basis saying, hey, what are the rates right now? And what are the amortization schedule? I think you need to have an idea. When you have a deal lined up, you run it through the pro forma, it pencils out. You can say, hey, Paul, let's work on this one. What do you think about that? Is that also a fair assessment there?
Yeah, I totally agree. We send out a monthly rate update sheet. And again, there's lots of variables that go into the rates. They're always going to be a little different, but that's to get you the ballpark. If anyone emails me, I'm happy to add them to that list. And my email is Paul, just my first name, Paul, at bmfcap.com. So it's the initials, Bonneville Multifamily, BMF, CAP, short for capital.com.
Awesome.
And I'll add you to the list so you can get that every month to stay in touch.
Perfect. Awesome. Well, Paul, thanks for the information today. I have a couple of questions, some advice regarding for new investors and also people that are private investors that are looking to maybe put some capital to work, investing on the equity side of some deals. Any books you would recommend?
I'll tell you one that I just reread, and I think if I'm willing to reread a book, because I'm always interested in new information, it bears mention. It's a quick read. It's called The Compound Effect by Darren Hardy. And as investors, we should be familiar with the miracles of compound interest over time. And it's more of a personal growth book, but it's through establishing the right habits and doing the right things consistently, and how that can have a very significant and exponential effect on our lives. You could probably read it in 3 or 4 hours. But great book, The Compound Effect by Darren Hardy.
Awesome. Yeah, I haven't heard of that one, but that sounds like a good one. Any advice that you would say for new, you said some advice, do the pro forma before for the new multifamily investor. For private investors, someone that's looking to put equity to work, one thing they should consider when investing with a sponsor?
There's a lot of things to consider. And I think, even though this isn't real tangible, but what I'm going to say is trust your gut. You do your due diligence, you get to know the person, but I think there's just there can be an intuition and a gut level feeling. And, I've raised capital, and I think I've done that through the trust that I've been able to build, but even asking people why they invested, that's been a common theme, that it just felt right. And so that is completely opposite of, crunching the numbers and doing your pro forma and all that. But I believe in a higher power and karma and all those things. And so I think there's an intuitive side. There's plenty of books written about that as well. But it's a fine line, because we can get scared and talk ourselves out of things, and you got to be cognizant of that. But ultimately, if it just doesn't feel right, it's probably best to wait for the next one.
Excellent. Well, with that, I want to thank Paul again for being so gracious with his time. And I want to thank everyone that's listening to the call today. Take care, Paul.
All right. Thanks so much. Pleasure.
Thanks for tuning in. I hope you enjoyed that episode with Paul. By now, you should be knowledgeable on a few options to obtain financing for multifamily properties. To learn more about real estate investing or how to be a private investor, visit our website at www.everythingaboutwealth.com. If you like the show, don't forget to subscribe and like us on iTunes or your favorite app. With that, we'll see you on the next show.